Welcome back to CPA Mastery. In this lesson we focus on exclusions from gross income. Gross income is defined very broadly under the Internal Revenue Code. In general, any economic benefit received by a taxpayer is included in gross income unless a specific rule excludes it. However, Congress has created several important exclusions that remove certain types of income from taxation. Understanding these exclusions is important for the CPA exam because questions often require you to determine whether an item should be included in gross income or excluded from it. By the end of this lesson, you should understand what an exclusion is and recognize several common exclusions tested on the REG exam. In this lesson, we have three main objectives. First, we will define what an exclusion from gross income means under the tax law. Second, we will examine several common exclusions that frequently appear on the CPA exam. These include municipal bond interest, gifts, and life insurance proceeds. Finally, we will discuss how to recognize exclusions when solving CPA exam questions so that you can correctly determine whether income should be included or excluded from gross income. An exclusion is a type of income that the tax code specifically removes from gross income. Even though a taxpayer may receive economic benefit, Congress has decided that certain types of income should not be taxed. Because gross income is defined broadly, exclusions must be specifically written into the tax law. For the CPA exam, it is helpful to remember that income is generally taxable unless a rule clearly excludes it. Many exclusions exist because Congress wants to encourage specific activities or achieve certain policy goals. For example, municipal bond interest is excluded to help state and local governments borrow money at lower interest rates. Other exclusions may exist to avoid unfair taxation or double taxation in certain situations. Understanding the policy reasons behind exclusions can help you remember them more easily for the CPA exam. The CPA exam frequently tests several well-known exclusions from gross income. Municipal bond interest is one of the most common examples. Interest earned from bonds issued by state or local governments is generally excluded from federal income tax. Gifts received from other individuals are also excluded from gross income for the recipient. Finally, life insurance proceeds paid because of the death of the insured person are generally excluded as well. Interest earned from municipal bonds issued by state or local governments is generally excluded from federal income tax. This exclusion exists because the federal government wants to help state and local governments borrow money more easily. By making the interest tax-free at the federal level, investors are more willing to purchase these bonds. Suppose a taxpayer receives a gift of $5,000 from a friend or family member. Even though the taxpayer clearly receives an economic benefit, the amount is generally excluded from gross income because the tax code treats gifts differently from compensation for services. Consider a CPA exam-style question where a taxpayer earns $800 of interest from municipal bonds. Because the bonds were issued by a state or local government, the interest is generally excluded from federal gross income. A helpful strategy for exclusion questions is to begin with the assumption that income is taxable. Then ask whether a specific rule excludes the income from gross income. If no exclusion applies, the item is generally included in gross income. Gross income includes most economic benefits received by a taxpayer. However, the tax code provides several specific exclusions that remove certain items from gross income. For the CPA exam, remember that exclusions must be explicitly provided by the tax law. If no exclusion applies, the income is usually taxable.